This episode of Toy Time is brought to you by Kim Mackey. Miss Mackey teaches social studies in Raleigh, North Carolina. Miss Mackey is going to teach you all about the world of stock markets. You probably have heard the term stock markets in the news lately, or you may have studied them previously in another history class. I want you to take a minute before Miss Mackey's lesson begins to think of two things that you know to be true about stock markets and two questions that you may have that you would like answered during this lesson. You can jot these questions and comments down on a sheet of paper or just think about them.
Hi everyone, my name is Mrs. Mackey. I'm a 15-year social studies teacher. I've taught both middle school and high school, mostly in Wake County. I am really excited to talk to you today about stocks and the stock market. And I hope that this is an activity not just that you can learn more about how stocks work, but also an activity that really engages you, your friends, your family from a distance with a stock market simulation that we'll work towards as well. So thanks so much for joining. Special shout out to my seniors in my civics and economics courses at Green Hope High School. My hearts are definitely with the class of 2020 in general in light of everything going on and the uncertainty that it poses, particularly for your senior years. But we're happy to have all of you join us on the Teach on Your Time series that Miss Mariah Morris has put together. So let's just start with the basics. What is a stock? A stock is a portion of a company, so like a piece of the pie, there, that looks a little more pie-like, that is sold to the rest of us to buy. So when you buy a share of a stock, and shares are the little pieces that we buy individually, so a share of a stock, you're literally owning part of the company. Now, I remember my 8th grade teacher, Mr. Udacek, when he shared that with us, we're like, yes, we can be corporate owners. But he really kind of brought us back down to earth a little bit when he said, you know, you might own 50 shares of stock in a company, and what you end up owning is a few pieces of toilet paper in one of their bathrooms. Now that might be a little bit exaggerated, but it really put into perspective for us of even if you own a lot of shares of a company, relative to the size of that company, usually it's just a pretty small piece. Hang on, let me put this back. It's in short supply. All right, so you probably have some understanding of why we would want to buy a stock. We want to buy stock in order to make an investment and to try to make money for the future. Well, it's a similar reason for why a company would want to offer shares of stock. They're trying to raise money for themselves in order to achieve a particular goal for their company as well. And there's a few ways that they can go about doing this, even without selling stock. So similar to what we may do or what some of you may be thinking about with taking out student loans is you take out a loan and you use that for something that you need within a certain window, and you take a longer window in order to pay it off. But what do you think the downside is for taking out loans? Right, it's interest. So let's say that you borrow, or you're a company, you want to borrow $1 million. So if you want to borrow $1 million, it's not going to cost you, or you're not just going to pay back $1 million. Depending on how long you take to pay off that loan and how high that interest rate might be, it might cost you $400,000 to borrow that $1 million. So as you can see, they're a little more reluctant to take loans. The plus side of getting a loan, though, is that the company and the owners of that company, they still own all pieces of the pie of that company. So that's one reason why a loan might be more appealing. Another way that companies can try to raise money for a particular purpose is to offer what's known as equity. So an equity is, if this is the company, they want to offer a piece of that pie, and let's say they're going to sell off 10% equity of their company, and they want to shop around with some private investors or some other investment firms who may be willing to say, you know what, we'll give you $1 million for 10% of your pie. Does that sound familiar? Anyone see Shark Tank? If you haven't, that can also be something you add to your distance learning list. That's one way that those small businesses and those entrepreneurs try to get people on board, is to make an appeal offering the part of their company, assuming their company's going to get bigger, therefore that piece of the pie, even if it's 10%, if the whole pie gets bigger, then it makes for a worthwhile investment. So definitely check out Shark Tank if you haven't done that as well. The positive aspect of having those private investors is you still retain some element of privacy with your business. So your financial reports are really no one else's business except your own. And there's reasons why companies just want to have that privacy for competitive edge, or not having to disclose things that wouldn't just be available to the general public, but also to other companies that they're participating in. Another way to offer up and try to get more people to invest would be to publicly sell stock. So one example of this from my own lifetime was my great uncle. I grew up around Rochester, New York, and in order to keep the Rochester Red Wings in town, they wanted to do a fundraiser in order to keep the baseball team there. So what they did, Maury Silver, who was the owner, sold shares of Red Wings stock. And this is a stock certificate that's been passed down from my great uncle to my uncle, who's now passed it down to me and my kids. So this is what it looks like as proof that you actually own shares of stock. So any companies that are trading on the stock market have chosen that third option as a way that at one point, at least, they were trying to raise money in order to pursue something, whether like the example I showed, trying to keep that baseball team in town, but usually those reasons have more to do with trying to bump up a fund in order to develop research for products, or if they want to expand their business. Those are typically reasons why a company may be interested in selling stock. The reason why they would be more inclined to do that publicly instead of privately is then you have so many more people who would be willing and able in order to buy some of those shares. So by putting it out, you have a lot more people who can buy smaller shares, but when you put it all together, you have a much broader possible market of people who would be willing to purchase shares of your company. So let's go over, I'm just going to step into my own home office here. Hope you don't mind, I'm working from home. All right, so if we have a company here, and this is their piece of the pie, and we're going to assume that they want to offer 10%, not drawn to scale, 10% of their company. And what they're hoping is by offering 10% of their company, let's assume that they also want to raise $10 million. And this is 10%. So if they're offering 10% of their company in exchange for $10 million, what do you think the next thing is that they need to decide if they're trying to figure out how to ultimately put this, these shares onto the stock market? Right, they need to then break it up into smaller pieces. And depending on how small they make those pieces, the wider the possible market of people who are willing and able, in order to purchase those shares, are actually able to buy those shares of stock. So let's say that this company breaks 10% into, and they want $10 million, and let's say that they break it into 1 million shares. So if we take this, we break it into 1 million shares, how much would each share of stock be? You're welcome, I made the math easy. Right, $10. So it would be $10 a share. And this $10 a share is known as the IPO. And the IPO stands for the initial price offering. Okay, so initial means first. So the first time this stock hits the market, what is the initial price for the share? So it's $10 per share. Now this is the only time that a company has exclusive control over the stock price, or the share price, see I'm doing it too, over the share price of its stock. After that, it's just a matter of supply and demand. Now the company can do things to try to influence the demand and how much people find those shares attractive, but they can't ever say beyond the initial price offering that their shares of stock are going to sell for anything else. They have that $10 a share, they raise their $10 million. Again, maybe they're doing that to expand their business, or maybe they're trying to get a certain product in development, and now they got that money. What happens next is up to the market. So we know that the shares are not going to stay at $10 likely, and the price changes. But why does the price change? So let's assume that we're buying shares of stock of the company that makes Lysol products. What do you think has happened over the last few months for products like Lysol wipes? Right, demand has increased. And since demand has increased for those products, perhaps investors are more optimistic about the future of that company in its production of Lysol wipes and growing and making more money. So the demand curve ends up shifting. And in microeconomics, they're known as determinants of demand, the reasons why this curve shifts. But the one that's most applicable here is a change in investor expectations. So that's the only reason the price of a share of stock changes, is because what investors expect that company to do in the future, either they become more optimistic about that company's future growth, or they become pessimistic about that company's future growth. And that's what drives and shifts this demand curve. So let's take the company who creates Lysol wipes. And let's assume that people are suddenly saying, oh, well, you know, we're optimistic about the economic growth of this company because they make Lysol wipes and a lot of people are buying them now. So the demand would increase. When the demand increases, we have a new equilibrium. And when we have a new equilibrium, that's the place where there's an exchange. So more people are willing to pay higher prices for a share of stock because they're optimistic. They think even though they're paying, let's say now it's $12 a share, they're still betting on in the future it will be worth even more, and they'll find someone else in the future who's willing to pay more than $12 a share. Now the opposite is also true. So we know lately shares of stock have been falling in price. So when they fall in price, it's because of investor expectations. And when investor expectations are more pessimistic on the economic futures of different companies, then we see a drop in demand. And when demand drops for shares of stocks, and it could be because people are pessimistic about what's going on, or they're uncertain. Uncertainty in a market can have the same effect as pessimism, because if we can't predict it, we can't plan for it, and that makes us uncertain, so we choose to play it safe, and we may see a drop in demand for shares of stock. I know what you're thinking. Enough about the background, Mrs. Mackey. How do I make it rich in the stock market? I don't know. But I do know of two metrics that you can use in order to try to make informed decisions. But the only for sure way to make it rich in the stock market is to have a crystal ball. Sorry. PE ratio really helps us to understand, and is an attempt to try to compare the optimism or pessimism, or whether people think that there's a high growth potential for that company, or whether it may be more in line in the future with what the company is currently doing now. So the PE ratio stands for the comparison between the price of one share of that stock and the earnings of one share of that stock. And there's always going to be some sort of gap, because the price, we buy shares of stock not for what that company is doing now, but what we think it will do in the future. So the share price of a stock is a measurement of what do people think that company may be doing with regard to its growth in the future. But the earnings are based on now. What is that company currently doing? So if in theory I were to take my one share of stock and say, never mind, I don't want it anymore, just give me what it's actually worth and split up the earnings with me, the comparison between what it's actually worth now based on the earnings versus the price of the share of stock is the PE ratio. And there's always going to be a gap, again, because we buy based on what we think it will do in the future versus what it's actually doing now. Depending on the industry, there are different average PE ratios, but let's just say, for example, that an average PE ratio is 30. So that means that anytime you buy a share of stock, on average, you're overpaying 30 times the value of what it's actually worth now. But you're not buying it for what that company's doing now. You're buying it based on what you think that company will do in the future. And that's why you're willing to pay 30 times the value of it, because you're assuming in the future it will be worth even more. So for example, if we're continuing with this average, let's do a little bit of algebra. If I paid $450 for a share of stock, and the PE ratio is 30, how much is the earnings for that one share of stock actually worth right now? You got it. $15. So the reason why we buy it isn't because it's technically worth $15 now. It's because we have so much confidence in the future of that company. That's why we're willing to buy that share in the first place, that we think it will be worth more in the future. When we're evaluating PE ratios, if it's below the average, there's not quite as big of a gap. So let's say, for example, there's a PE ratio of 3. Now keep in mind that's extremely low, but instead, if we have that same share, that's $50, then what is it worth? $150. So now that gap got smaller. Now, if you're a conservative investor, lower PE ratios would probably be more appealing to you, because it won't be as far-fetched that the company will be doing a little better, maybe not drastically better than it currently is now, because we know what it's doing now. But what if, and we see this with a lot of newer companies, if the PE ratio is 300? So $450 for that share of stock, and it's 300, it's actually only worth $1.50 based on its earnings. So if you're a risky investor, a higher PE ratio would be more appealing, because enough people are willing to pay a high enough price that they think it's going to be a lot of growth in that company in the future. But just as your parents say, just because everyone jumped off the bridge doesn't mean you should do it either. So if you're a risky investor, you may take this as a good sign that there's a lot of people who are optimistic, but because none of us have a crystal ball, and sometimes things happen, just like the moment we're in now, you're taking on a bigger risk that it may not happen. Okay? So that's the PE ratio. The second metric that we're going to look at is beta. Beta helps us understand what is that share of stock doing in comparison to the rest of the market. So if we're going to again draw a graph, this one will look a little different though. We'll still keep the y-axis labeled price, but this time instead of our x-axis being labeled as the quantity, we're going to label it over the course of time. So if, let's say, the average stock looks like this over time, let's make a sine curve. See, now you can tell your math teachers you did some math practice today. So let's say on average, this is what the stock market is doing. The beta figure here, it's a beta of 1. That's our baseline, okay? So a beta of 1. Now, what if a share, instead of sticking with the trend, it tends to fluctuate where the highs are a bit higher and the lows are a bit lower? What do you think the beta would look like for that? Greater than 1 or less than 1? Right, it would be greater than 1. And the reason for that is since it's fluctuating more than the average share in the stock market, it would have a figure greater than 1. But it's going to be in terms of decimals. So if you were to predict about how much is the fluctuation higher or lower, what percentage? Let's say 30%. So what that would mean is for this in particular, it would be a beta of 1.3. So the 0.3 indicates that this share tends to fluctuate 30% more than the average share of stock. If a share fluctuates less than the trend of the market, it would have a beta value of less than 1 because it fluctuates less. The highs aren't quite as high, the lows aren't quite as low compared to the average share of stock. So for this one, let's say if this beta, let's assume it fluctuates 20% less than the average share. What do you think the beta would be? So if the baseline is 1 and it fluctuates 20% less, the beta value of our blue line would be 0.8. So risky investors are going to want to look for beta values that are higher than 1 in order to try to reap the benefit of the bigger reward. They're not going to focus as much on, it may go down even further. So riskier investors tend to focus on, well, it follows the trend, it outperforms it when times are good. If you're a conservative investor, you may want to focus more on a beta value less than 1, because the conservative investor is going to focus on, okay, well, I may not reap quite as many benefits, but when it goes down, it doesn't go down as far as the average share. So I'm less likely to lose as much money, not any money at all, because you can lose money in the stock market. The average can go down. But when it falls, it doesn't tend to fall quite as far, so you may be less likely to lose quite as much. So PE and beta are the metrics that would be good for you to look at. There are so many others out there as well, but for purposes of trying to just help you guys get your feet wet, kind of like how mine are in the newly cleaned shower, we're trying to just help get you an understanding, generate some interest, and give you something to do while you're at home.
Miss Mackey just taught you a wealth of information about the stock market in our country. I challenge you to pick 3 or 4 stocks to follow over the next couple of days. Try to find any trends that you may be able to identify based on the information that Miss Mackey just taught. Have fun and happy learning.